Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I'm going to talk about one of my favorite REITs. REITs are real estate investment trusts. They pay a lot of dividends. A lot of them have a high dividend yields. They are expected to pay about 90% of their income, basically the profits, back to the shareholders in terms of dividends and so on. So I really like REITs, and REITs is an easy way of investing in real estate because, of course, in order to invest in real estate, what do you need? You need capital, you need a lot of money, but investing in REITs is quite good. Now, the issue with REITs is the fact that a lot of them are non-Sharia compliant, so it's very difficult to find companies that will stay compliant because any companies that are dealing with mortgage side of it, you don't want to touch those. So I like the public storage companies side of things. Okay, I like the storage companies. That's what I mean. And the company that I'm talking about today is Public Storage, like I just said. Now, before we get to the video, as always, like the video, please, because it really genuinely helps. And if you can join us in the Patreon account, that would be absolutely amazing, where you get access to all of these things here, including the basically access to the Discord, inshallah. Now, let's talk about Public Storage. This company is currently trading $288. Like I said, it's a REIT. Now it's down about for the 1 year, it's about 3% down, but for the last 6 months, it's down for almost 5.5%. So it recovered quite a bit at some point. So if I show you just for the 1 year, it was down quite a bit, and then it bounced back all the way to $319 per share. Since January the 1st, it has been going down. Okay, so it's basically I stopped buying it, and then now I'm like, okay, I'm really interested. And as you can see here, the rating summary is all buys. So we'll look in that in a second. So we'll give you a bit more details on everything else. So in terms of the company, they've been operational over 50 years now. Enterprise value of $59 billion. Of course, a publicly traded company, is the 5th largest REIT by enterprise value. Credit ratings, okay, the Moody's has actually rated A2, and S&P has rated an A, which is quite good. Okay, they are in almost 40 different states. They have over 3,000 properties. They've got loads of customers in place right now, almost 2 million. Okay, rentable square of 217 million. So it's a huge company. It's not a small company at all. And currently, as you've seen, it has $51 billion in terms of market cap. Dividend yield of 4%, which is quite huge. And the dividend growth for basically since the reason it was 50%, which is growing basically that dividend very, very fast. Now looking at the payout ratio. Now, mind you, the REITs are normally about 90%. Below 90% is actually quite nice. So 76% is basically what they're paying right now. In terms of the latest increase, February of last year, that was 50%. So they have not been increasing consistently, but they have jumped from basically 50% in the last one. Okay, and the last 8 years, they grew this dividend about 8%. And as you can see, there's a massive jump basically in the last couple of years. Now you will be surprised. So there's of course zero, but look at this, 12 annual payout of $12. So it has jumped from basically quarterly from $2 to $3 per share, which is quite nice. Now it looks like it's undervalued because when you look at the average, the 5-year PE average, dividend yield average is basically 3.44, and currently is 4, so over 4%. So that basically, based on the dividend theory, it actually looks like it's undervalued at the moment. And looking at the price to fund from operations, it looks as is also cheap as well, because 19, and then real estate is actually about 14. So it seems a little bit expensive, but when you look at basically the 5-year average and where it is now, it seems a little bit cheaper. Okay, but when you look at the overall the sector, it seems slightly expensive in terms of that. Now looking at a few more things, adjusted FFO for our fund from operations, which is what we use REITs, you don't use free cash flow normally. Okay, it's better to use the funds from operations, and as you can see here, below 90% is basically what's expected of REITs, and that's exactly where it is right now. It was 76%, like we've seen already. Next year will be 80%, so it's still below the 90% that we're looking for. Adjusted FFO per share, as you can see, increasing every single year. Like we said, we're not going to look at the free cash flow there. And then adjusted FFO per share growth is actually been declining last couple of years, but I'm not really concerned about that at all. This is where it gets interesting. So shares outstanding is actually increased, and I think it is something to do with the news that I'm going to share with you guys. Let me find it. And something to do with this. I think they reported the earnings recently. So this was the October 30th they've reported, where they beat top line, bottom line, in line basically, and beat the in terms of the FFO, in terms of the core FFO. They talked about all of these things, but this is the bit that I wanted to talk to you about. There we go. BREIT simply Storage LLC is the company they acquired. So they bought this company, so that's probably why this jump here. Okay, 2022, maybe that's what it is. I don't know. Maybe they used it for I would love to see actually how much they paid for that company, and basically how much of it was cash, how much of it was basically shares and so on. But as you can see here, total sales, which is quite nice, from $2 billion to right now $4.5 billion, which is quite nice growth for the last 10 years. Return on equity, we're looking about 21% right now, to return on invested capital of 12%, which is really good. And then operating margins of 52%, free cash flow margin of 66%, and then net debt to EBITDA right now below 5.5 is what basically is preferred. Right now it's 2.46, so it's absolutely fine. So yeah, in terms of this side of things, there's absolutely no issues. If we go back here and go to earnings, we want to see how what the company is expected to do in the next few years. I think the upcoming earnings have not been announced yet exactly. They haven't given us any date yet, but that should be very soon. Okay, so a lot of companies are reporting. So if we look at the 2023, so they've got one more quarter to report. So that they basically growing their the FFO about 6%. 2024 is almost flat. That's probably why the stock's down. And then 2025 is 4%, and then 4%, 5%. Again, is REITs is not gonna basically grow as fast as, you know, those big flying companies where you got 10-15% every single year. So you get your 5% to 10% every single year. And then basically they're expecting the revenue side to grow about 7%, then 4%, 5%, 6%, 4%, 5%. So again, it's nothing to shout out or anything to really be concerned about. The fact that this company pays excellent dividend. And again, remember, when you own a REIT, you would hope for to have at least a massive price appreciation, but at the same time, you're in it for the dividend side of things. The fact that it's a very stable business, and you know that, especially with Public Storage, which owns a lot of other companies within that that operate around Europe and around, you know, United States and so on. Right, if we compare it with its peers, so the first company that we're looking at is the Extra Storage company, as well as Cube. So those are the two companies we want to compare, as well as the S&P 500. I believe Extra Storage space is actually slightly bigger than Public Storage. I'm not sure Cube. I'm gonna actually check that in a second. But if we look at for the 1 year, as you can see, this one is 1.73. The S&P 500 has actually done really well, because the REITs did not do well. Let's just say that they did not do anything last year. So if we look at the 3 years, 45%, let's call it 46%. The S&P 500 basically was only 27% in that period of time. This is total return, by the way. And this one is actually returned 43%, 44%, and this one 44%. So they are kind of similar, but all three of them have beaten the S&P 500, which is quite interesting to see, because REITs, you don't really expect that. And then when we look at the 5 years, almost to 70%. The S&P 500 was 85%, 81% for this one, and 78% for this one. So it's the lowest, but it's still 70% closer to almost 10% the difference between the S&P 500 and this company. And I really like that. And when you look at the last 10 years, 170%, 174%, 356%, and this one has returned 300, almost 300. So the other two have done absolutely better, but it's almost in line with the S&P 500. So you're slightly either beating the S&P 500 or you're getting basically similar to what the S&P 500 returns. And remember, on average, the S&P 500 will give you about what, 7 to 10%. And if you can get that from this company every single year, what else do you want? Okay, and it has a very low debt. That's one of the things I like about this company. Now, looking at the rating side of things, Wall Street, according to Wall Street, they actually saying is, of course, they've said it is a buy, but their price target for this company, when it loads up, as you can see here, there we go, $315 per share. That's about 10% upside from where we are right now. And you've got 6 strong buys, 4 buys, 7 hold right now. Now, if we go to Morningstar, as you can see here, is $317 per share is basically where they think it's 3 stars right now. $317 per share is where they think the price should be. It's about 300 in terms of that. According to Simply Wall Street, they are actually saying, if we go to their valuations, almost to 40% basically undervalued at the moment. $464 per share as well. That's where they think the price should be, which is absolutely huge. I would love, if that happened, that would be absolutely wonderful. Now, one more thing, in terms of next 5 years, they're expecting the earnings to grow about 17%. So next year is flat, we've already seen it, but then on average, every single year, you'll be making about 17%. And according to them, I think it's very similar to anyway, $317 per share is where they think the price should be. Right now, it's $389 per share. So just going back here, I'm going to show you, and as you can see here, that's my 5th biggest company that I own in this portfolio. As you can see, or the 4th, in fact. Okay, I have £4,777 in there. I'm gonna basically keep buying this company in the next few months as well, because I'm down. How much am I down? In fact, it's just not much. There we go, about 2%, 3%. It's actually gone up recently. So the last 3 months, at one point, it was almost $311 per share. My price is my average is $284 per share. But yeah, so at one point I was actually in the green, and then that line there is my basically buy price. So it's gone up quite a bit, and then now it has come back down. So I'm really interested in this company. I want to buy at least another 9 shares or so, and then just hold it just leave it alone, because it's got the price appreciation, it's got excellent dividend, and hopefully they wouldn't cut the dividend, but they will increase it as much as they can. Even if it stays stagnated, I don't mind, as long as they don't cut the dividend. I don't like when companies do that. So what I'm going to do now is, I've got about £116 in the account right now, so I'm going to buy half a share of Air Products and Chemicals and send that to the market, and that would give me about 18 shares. There you go, so about 18 shares. Now this is still undervalued, so I will be building this position, inshallah, as well as the other companies that I've talked about. If you're enjoying this transparency, if you're enjoying this type of content, please like the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.